The other day, I read about a digital bank freezing customer accounts. Thousands of people suddenly couldn't access their money for days, and it got me thinking, what if that happened to me? Or you? We trust banks completely, but do we really know what happens to our money once it's in there? Today, we're pulling back the curtain on what your bank actually does with your cash and how safe it really is. When you open your banking app and see your balance, maybe it says £2,000. It feels like that money is sitting there, waiting for you. But here's the truth, it's not. The money you think you have isn't sitting in a vault labelled with your name. It's already been lent out, invested, multiplied. In fact, the only thing your bank actually owes you is a promise. A promise that, when you tap withdraw or transfer, they'll have enough cash on hand to make it happen. And that promise works, most of the time. But what if too many people want their money back at the same time? That's when the illusion cracks, and we get what's known as a bank run. And to understand why that's so dangerous, we need to talk about something called fractional reserve banking. Sounds complicated, but it's actually the system that makes the entire financial world spin. Alright, let's pull back the curtain. When you deposit £100 into your bank, you probably imagine it sitting safely, waiting for you. But that's not how banking works. The bank keeps a small fraction, maybe £10, as a reserve. The other 90, they lend it out. To someone buying a car or a house or starting a business. But here's the trick. When the person spends the £90, it doesn't disappear. It ends up in another bank account. And that bank keeps 10% of that £90 and lends out the rest again. £100 becomes £90, and then 81, and then 73, and on and on. With every new loan, new money is effectively created. Not printed, not minted, just typed into existence. By the time the process runs its course, your original £100 can support almost 1,000 circulating in the economy. This is called fractional reserve banking, and it's how modern money is born. Sounds clever, right? But there's a catch. This system only works if everyone trusts that the money will always be there when they need it. Because if that trust breaks, if people panic and rush to withdraw, the whole thing can unravel fast. And in 2007, that's exactly what happened to Northern Rock. It's 2007. Britain's housing market is booming. Mortgages are easy, banks are lending fast, and Northern Rock is leading the charge. They're not a small player. By mid-2007, Northern Rock is the 5th largest mortgage lender in the UK. Their secret weapon? Cheap money from the global markets. Instead of relying on savers' deposits, Northern Rock borrowed billions from other banks and investors. They lent that money out as mortgages. It worked brilliantly, until it didn't. Because in the summer of 2000, something strange started happening across the Atlantic. The US subprime mortgage crisis. Suddenly, those global markets that Northern Rock depended on began to freeze. Overnight, the cheap funding dried up. And for the first time, Northern Rock needed the very thing it had neglected, the savings of ordinary customers. But when the news leaked that the Bank of England had quietly stepped in to support Northern Rock, panic spread faster than any press release could calm it.
One of Britain's biggest mortgage lenders needs emergency support from the Bank of England. Northern Rock has problems raising money because of the crisis in the financial markets.
Outside branches across the UK, queues began to form. People wanted their money, now. By the end of that weekend, customers had withdrawn nearly £2 billion. The images were shocking. Lines stretching down high streets, pensioners clutching passbooks, parents holding children while waiting to withdraw their savings. It was the first run on a British bank in over 150 years. And it happened not because Northern Rock ran out of money, but because people stopped believing it was there. That's the paradox of modern banking. Confidence is liquidity. Once trust evaporates, even a solvent bank can crumble in days. Eventually, the UK government had to step in, nationalise Northern Rock, and guarantee savers money in a bid to stop the panic. But the damage was done, both to people's confidence and to the myth that your money is always safe in the bank. So that was 2007, a lifetime ago in banking terms. But here's the question that still matters today. Could it happen again? The short answer, sort of. The UK banking system is a lot safer now. After Northern Rock, regulations changed. Banks have to keep bigger capital buffers and more reliable funding. Plus, if your bank did collapse, the Financial Services Compensation Scheme, the FSCS, guarantees up to £85,000 per person per bank. That means most ordinary savers would be protected. But there's still cracks in the system, because while the traditional banks are better capitalized, many digital-only banks depend on the same networks, the same market funding, and ultimately the same fragile thing, trust. And trust can vanish at the speed of a tweet. In a world of instant payments, 24-hour news, and viral panic, a modern bank run might not involve the queues outside branches. It could happen entirely online in minutes. The lesson of Northern Rock isn't just about banking, it's about human psychology and the illusion of safety. Your money feels solid, dependable, but it's really just numbers, promises, built on the collective belief. The system works, right up until the moment it doesn't. So how safe is your money in the bank? Safer than it was, but never completely safe.